Hello, August 2nd, 2025, and welcome to this week market dashboard. Interesting week where everyone was expecting the Fed's decision, but it was actually the jobs report yesterday that actually caught investors off guard. So let's take a look. So we are back into a more usual situation. Not usual because stocks, US equities are going down, S&P down 2.4% for the week, but while US equities are down, we have US bonds and the US dollar, which are risk-off assets, usual, regular, traditional risk-off assets going up at the same time. We also have gold going up. Gold was more hit at the beginning of the week, but recovered strongly yesterday on the very poor jobs report. Risk on asset, Bitcoin, which is down for the week, not surprising with equities. And we have oil going up, mostly based on the tariff agreements that have been signed recently. We have, we still have some ups and downs on the tariffs, but that are actually not based on trades themselves, but are more based on geopolitical consideration around Israel, specifically for Brazil and Canada, for instance. So here we have the market action for the week. You can see S&P was nearly flat for the week. Basically, they were waiting. Investors were waiting for the Fed's decision on Wednesday. The Fed that, although it was kind of expected by Kalshi markets, prediction markets, that kind of thing, that the Fed would not change its interest rate, would not cut at this time. The market took it negatively before slightly recovering before the close, and then the next day, Thursday, we opened a gap up after the very good results from Meta and Microsoft. But as you can see, the price action for the day after that was very weak until yesterday, when we had the jobs report that was really negative. Why? Because the results, the jobs well reported were much lower than expected. But on top of that, more importantly, it was the revision of the previous jobs report that were significantly down, which is definitely an issue. I've mentioned this in the lives last year, and in the newsletter, obviously, that the jobs number were wrong last year, but they were wrong last year, they are still wrong this year. And you know that Trump fired the head of the body reporting these jobs report. I mean, these numbers are all over the place. So whatever you think about, that situation politically, if the false job report is politically motivated or not, the fact is that whether it's a Democrat administration or Republican administration, these numbers are totally wrong and cannot be trusted. Now, if we zoom out, we can see the drop over the last week. That is, not really deeply concerning at this time. This is a warning. This is not a panic. We have the VIX reaching the 20 now. But, that correction comes after a massive run up. So it's not surprising that we actually may pause at some times. And we can always find a justification for this. This time it's a jobs report. We'll see where it goes next, specifically how the Fed responds, if it needs the response, because at this time the Fed is actually in a corner. They have to choose between inflation and the economy. Considering the level of debt of the United States, and what history shows us is that governments always choose to inflate their debt away. That's usually how it works, and I believe this is the reason why Trump is pushing for rate cuts by 3 full points. In terms of seasonality, here we have the VXX. I choose to show the VXX, which is tradable, rather than the VIX that is not. So what we see here is that first, volatility has been much higher this year than usual. I believe that's the result of the tweet policy. But what we see here specifically for this week and for the next, I would say, couple of weeks, August is always time of higher volatility that is also emphasized by lower liquidity in the market. So the fact that we are getting into bumps at this time is not totally surprising and not totally unexpected, considering the seasonality of the equity markets and volatility as well. And if we look again in terms of seasonality, here you have all years since 2000, the last 25 years, we can see that the US market, the S&P 500, is back above its average yearly performance when it came back from below its fifth percentile. So we are, despite drop this week, again, there's no reason to massive concern at this time. Another manifestation of this increased activity is obviously the activity ratios. What's interesting here is that they have bottomed up, and we can see that all the major representative of the major asset classes are all spiking at the same time, which is a little bit more concerning when everyone goes crazy. This is usually when things happen. Now this is the risk-adjusted momentum chart that I've shown you multiple times before, and this week is specifically more interesting than usual. Why? Because, as a reminder, the risk-adjusted momentum is an indicator of the positioning specifically of most investors, as most investors are momentum based. They are following the trends, whether they like to say it or not, but they are following the trends and they are risk adjusting their portfolio. So the risk adjusted momentum gives an idea of what the current positioning of many investors are, but more importantly, it gives an indication of where their positioning might go. And the reason why it's interesting this week is that we are seeing a rotation. We see the S&P risk-adjusted momentum weakening for obvious reason. The market dropped, but also the volatility increased, like we've seen on the activity ratios. We see that gold momentum is dropping, not so much because of the drop in momentum that we've seen that the gold has slightly recovered yesterday, but more because of the increased volatility at this time. This is the impact on volatility of that kind of indicators is obvious again on oil, because oil was improving on the week, but its volatility significantly increased, which reduces the risk-adjusted momentum. But the other part is also interesting, which is at the bottom of the chart. We see that the US dollar and bonds are now rising from the dead for a very simple reason. Increased activity that reduces the gross exposure, though center back its exposure around zero, but at the same time because of the risk off environment of the week, as we've seen on the first slide, then the momentum is improving as well. So which explains why both US bonds and both US dollar are recovering very significantly this week. Well, for risk-adjusted momentum, by the way. And the last point that I wanted to make is that, and I think what is interesting here is that we are seeing a rotation at this time from risk-on assets to risk-off assets. So again, it remains to be seen if it will continue, but this is the kind of situation that drives flow on the markets. And we may be at the beginning of a rotation on the market just because of that. So that's interesting to keep in mind, and we'll check what the situation is next week on this one. Now, looking at the equity sectors, all equity sectors were down for the week, but again, as you usually show, it's the relative performance versus the S&P 500 of each sector. And we can see that some sectors are doing better than others. The obvious ones, such as utilities in risk-off environments, did pretty well this week compared to the S&P 500. However, some other risk-off sectors did not do well, such as consumer staples, because both inflation and higher unemployment and the poor job reports will be hurting US consumers. But other than that, there were not really places to hide. Financials are down. The last one to be slightly positive up this week was the tech sector, pushed again by Meta and Microsoft results for this week. Now, a chart that I've not shown you before and is equity factors, some equity factor ETFs, just to show you that since 2024, the leader in equity factors have been momentum. This is not the classic, what you could think as absolute momentum. It's an equity factor based on relative momentum, where you would buy the best performing equity stocks, and you would short the worst performing equity stocks, and you get that kind of equity factor. So momentum is leading the way by far, and is still leading in 2025 when other factors are really suffering at this time, whether it's a quality factor, which didn't bump up this week, specifically in a risk environment. The minimum volatility factor slightly, but not much. The high yield dividend factor didn't perform either. And if we look at value, the value factor that is not here that I will add for the next time, it didn't perform well as well. So there's only one area to hide in terms of equity factors at this time, which is the momentum one. So I wanted to show you this chart one last time, which represents the performance of foreign equity markets versus the S&P 500. Why probably the last time? Because we are going back to the regular situation where it was kind of an anomaly. If you look basically at the longer term chart, that foreign markets were overperforming the US equity market. You see that on the very longer term since 2007, I believe here, whether it's uptrending markets or downtrending markets, foreign equity markets are underperforming the S&P 500. It's not surprised that the S&P 500 is the biggest equity market in the world. So what I believe is that we had this overperformance relative to the S&P 500. We are going back potentially to the regular trend. If you look at European markets specifically, it was kind of surprising that the European equity markets were overperforming that well the US equity markets because the economic situation in Europe doesn't just justify it. And if we actually look at, for instance, here the Euro Stoxx seasonality, you can see that the performance of the Euro Stoxx this year was one of the best over the last 25 years, which is unusual and far above its average performance over the last 25 years. So we seem to be going back to kind of normalcy in terms of performance of foreign equities, and specifically European equities versus the S&P 500. And I wanted to finish with this last chart, which shows the major currencies, and specifically the US dollar, that is not collapsing anymore. The tariff situation is normalizing. We have, like I said at the very beginning, slightly more risk-off environment at this time, specifically with the Fed being reluctant to drop interest rate to support the economy and still favoring the inflation at this time. Again, we probably don't have an exodus of dollars of investors towards foreign markets. Because of that, I explain how the US dollar can play a major role in foreign investments, specifically if the dollar weakens. So if the dollar is improving, it gives a better incentives for foreign investors to go back to the US market, specifically if we are going to the original trend where US equities are overperforming foreign markets. The major point will be to focus on what the Fed will be doing, specifically if inflation is not going down or even is going slightly up again, and if the job markets doesn't improve. Knowing again that we cannot really trust the jobs number that are coming out at the moment. So there we are for this week. Again, thank you very much for being here, and see you next week. Bye bye.